I'm Hunter Thompson, and welcome to the Cash Flow Connections Real Estate Podcast. How's it going, everyone? Welcome back to the show. Today, we've got Richard Duncan back. It's been over 2 or even 3 years since he's been on the program. You may have heard previous episodes. If not, we will link to them in the show notes page. Even if you have heard previous episodes with him, they've been really interesting and some of our highest reviewed episodes. So go check them out to kind of get a refresh. Richard is a former IMF consultant. He's been involved in various large institutions. He also runs a very cool blog and economics platform called RichardDuncanEconomics.com. He's one of the most sought after guests of this program. Richard, it's really an honor. Thanks again for coming on.
Hunter, thank you for having me back.
So we've got a lot to get to today. A lot has changed since 2021, which is the last time that we spoke on this show. Now, you and I talked about offline. You actually came and talked to Raise Masters about what to expect going into 2022, I should say. And we just checked the clock, and it looks like February of 2022 is the last time we talked. And then, as you know, March of 2022 was the first date that the Fed started raising rates in the United States. They would go on to raise rates faster. They've been risen in 40 years, which, you know, in my industry created significant distress in a lot of real estate deals and non-real estate deals. The bond market changed. And so I know we got to get to a lot today. But first, I want to open it up and say, from your perspective, what are some of the most important things you keep an eye on right now? We can talk about market updates in a second, but I want to start with, what you're seeing and noteworthy things, especially as it ties into like your view of things in your book.
Right. So in early 2022, my most recent book came out. It was called The Money Revolution: How to Finance the Next American Century. And the objective of that book was to persuade the American public and US policymakers that the United States could and should make a very large investment in new industries and new technologies over the next decade in order to induce a technological revolution that would turbocharge economic growth, create vast amounts of wealth, deliver technological breakthroughs with the potential of curing all the diseases and radically expanding life expectancy, and also shore up US national security, given the growing threat that China poses to the United States. So that was when we last spoke, just around that time the book came out. And it didn't gain very much political traction, at least initially. But then in August of that year, the Congress passed the CHIPS and Science Act, which was a very big step in the right direction. That was $280 billion for new investments and new technologies, with $52 billion of that directed to building semiconductor factories in the United States. Then in February of last year, I was invited by a congressman to go to Washington and make a speech to a group of congressmen and women from the House Ways and Means Committee, explaining the ideas in my book. And so that was great. That was a real honor and a fantastic opportunity to get the message out. And then coming to answer your question, what's on my radar right now is last month, both former President Trump and the Biden administration announced their support for the establishment of a U.S. sovereign wealth fund to invest in new industries and new technologies. So that was just fantastic news. I was extremely pleased and relieved because this is exactly what our country needs going forward. So that's the big thing that I've been focused on in terms of, this is something that I've been promoting well before this most recent book was published. I've been making this argument going back for 15 years. So that's the big thing that's happened in my world.
When you talk about the risk from China, what is your perspective on, and we've talked about this before, but I just want to, we want to update it and provide context for listeners, et cetera. What is your view of the risks of China in today's climate?
So we're about to be overtaken by China economically, technologically, and therefore militarily, for one simple reason. China's government invests far more in new industries and new technologies than the US government does. And they're ramping this up at an extremely rapid pace, and they're overtaking us. That's why they had 5G so many years before the US did. And that's why they have, for instance, hypersonic missiles, and the United States still doesn't. It's why they're dominating the electric car industry. So if the United States doesn't very soon radically increase its investments in new industries and new technologies, then we're going to be left in the dust by China. And that will make us a vulnerable, has-been power, essentially at China's mercy. So I'm very worried about this. I'm not the only one. Congress has woken up to this threat posed by China. That's why they've done things like pass the CHIPS and Science Act. The $280 billion to be allocated over, 5 to 10 years. That's a nice step in the right direction, but it's far too small. We need something like that on an annual basis, not spread out over 10 years. So that's why the announcement that both parties are now in favor of establishing a U.S. sovereign wealth fund to invest in new industries and technologies is such a relief to me and such an important development for our country.
When you think about the global economic spectrum, let's say that China does come up with technologies and the missiles example is a unique one, but let's say, they come up with supercomputers or 5G, for example. From your view, how does that turn into something that's negative? I could see unique proprietary missiles, for example. That would be, you don't want people that don't view you favorably or have similar worldviews of you to have, more military might than you. But in terms of technologies and stuff, how do you view that as a negative outcome versus, okay, now there's more access to 5G. Maybe that research and development is done. Maybe we can reproduce it more cheaply, for example. I'm sure you've dealt with that and thought about that as well.
The most worrying angle is we are in a technological arms race with China, and artificial intelligence is the key. Whoever develops artificial general intelligence first, the point where the machines are as intelligent and capable of doing everything that humans can do, then from that point on, that intelligence increases exponentially. And whoever gets there first will effectively dominate the world. They will have ultimate power. And so we have to make sure that that's the United States and not China. I don't know how much you and your listeners focus on technology and technological developments, but everything's accelerating at such an enormous pace now, in part thanks to the development of generative AI, for instance. But we're moving into a new age where things are changing very quickly. To answer your question more directly, there's a real threat that China will invade Taiwan. And if it does, the United States and China will be at war. And if we're at war, then we could be hit by a Chinese version of Pearl Harbor with new technologies that people haven't even imagined possible. I mean, imagine in the not too distant future, swarms of poisonous nanobot drones being sent to the United States by the billions. That's the sort of technological future nightmare that we're looking at in the not very distant future going ahead. We have to ensure that we're not only able to counter threats like that, but be so strong that no other power would dare attack us the way that Japan did and caught us off guard at the beginning of World War II. And we are really at risk now. Our national security is at risk. And we need to take steps immediately to ensure that we are not surpassed technologically by China. Because as I said earlier, they are investing more than the US government is in new industries and technologies, and they are surpassing us. And they're going to do this at an accelerating rate because their investment is growing very much more rapidly than our investment is. Back in 2000, the United States invested roughly 10 times as much as China did in research and development. But now China is investing more than the United States is. So if you keep extrapolating out these trends for the next 10 years, the sun's going to set on the United States, and there will only be one American century, and it will be over. That's why I wrote this book, The Money Revolution: How to Finance the Next American Century, arguing that we can and we could easily afford to invest, I believe, on a multi-trillion-dollar scale over the next 10 years in these future industries and technologies, things like not only artificial intelligence, but quantum computing, biotech, nanotech, genetic engineering, robotics, and developing fusion, cheap fusion. And if we did that, that would produce as I said earlier on, just technological miracles. And it would also shore up US national security for generations to come, turbocharge economic growth, make the economy grow at a much faster pace than it has done in recent decades. And everyone would benefit. Not only Americans, but everyone around the world would benefit from these technological breakthroughs.
I'll ask another question about China. What is your view about, as opposed to, and I have, maybe even mixed views about this, but I have concerns not necessarily of as China as the enemy, but China as the model. We don't have to go into, my particular views and all that, but I have a vision that's far more concerned about the union between China and the US than the, for example, like a likelihood of a hot war. So when I hear about, China's investment in this, that, and technology, I see that as being the US's guide for what they want to do. But I'm not so sure that, let's say, government investment would yield those types of results, especially when I look at the way that the government generally runs things. It's hard for me to imagine a future where China, with a lack of true free market, could surpass the United States in a lot of ways, especially when it comes to technology. What are your thoughts on that? And obviously there's challenges with China's economy and these types of things. I'm confident you've thought about that and contemplated that as well. What are your thoughts there?
Right. Well, in terms of having doubts about them challenging us, I would just encourage you to consider that we have to put 100% tariffs on Chinese electric vehicles to keep them out of the United States because they're so much more competitive, cheaper, better technology. That's just one of many examples of where they're surpassing us technologically. So they are challenging us without any question. They are there. It's just a matter of, are they ahead yet? And maybe not, but they will be within the next few years. But in terms of your question about your doubts about the U.S. government being able to do this well, and make investments well, that's why a U.S. sovereign wealth fund is such an exciting thing. Because in a sovereign wealth fund, the government wouldn't be carrying out these technology development projects on its own. The sovereign wealth fund, the United States government would take equity stakes in existing companies and in startup companies, much like a venture capital company. So this sovereign wealth fund would fund investments in companies that are run by America's best entrepreneurs and scientists. And the beauty of that is the government could fund this on a very much larger scale than the private sector can. And the really great thing about this is when these companies, these effectively joint venture companies in which the US government holds a big equity stake, when these companies start delivering technological breakthroughs, things like cancer vaccines or cheap fusion, which would provide limitless energy, then they could be listed on NASDAQ with trillion-dollar valuations. And the government, in other words, the American public, would be equity owners in these. So the public would benefit directly. Just for instance, when these companies begin making extraordinary technological breakthroughs and huge profits, then the government could send out dividends to the American public, dividend checks, as payments as a result of because these companies, which the American public would own, would be so profitable. Or the American public could, these things, I really believe these things would be so profitable that they would pay for themselves many times over. And once that begins, then taxes could be reduced in the United States, or even the US government debt could be paid down. So rather than these investments causing US government debt to increase, I believe, looking out 10, 15 years, that they would result in US government debt going down because they would be so profitable.
Fair enough. I know we've discussed that matter before, and it's interesting because, I think when you and I exchanged emails, it was surprising. Like, my view is that this is going to happen whether I want it or not. And so I'm actually very confident that there's not going to be just one of these funds. I'm confident that there's going to be many. I know that is good news to you, but I'm still hesitant to believe that we're going to actually see those checks anytime soon. And I'm sure you've dealt with other people that feel the same. But I do want to transition to the conversation around debt. Yeah, go ahead.
Let me just conclude. I would like to try to persuade you to reconsider, or at least keep an open mind. And I'd certainly like for your audience to keep an open mind, because I believe that this would truly be so beneficial to the American public, both in terms of individually, as diseases are cured and life expectancy expands and the economy booms, but also at a national level, shoring up our US national security. So I'd like to persuade the American public to get behind this idea. This is something approved by, as I said, former President Trump and the Biden administration. So both parties are now on board with this idea. I want the American public to understand why they are, and why this is such a great thing, and why the American public needs to get behind it.
Let me ask a more pointed question on this topic, and I'll kick it back over to you so you can answer kind of what's on the minds of a lot of people, I'm sure, listening to this. What you just outlined, the investment, the return of investment, the dividends, all of that, the billions of dollars that are going to be invested, better than maybe Peter Thiel, that's going to be managed by the same people that are bipartisanly sending billions and billions of dollars to Ukraine, weapons manufacturers, the same people that run the Social Security system that's going to be bankrupt. And obviously, you know all that as well. So can you speak to that? Like, that's really what the crux of the discussion is. It sounds good. I'm interested. But at the end of the day, the people that are going to be managing what you just outlined are responsible for those types of things as well. How do you respond to that? And we don't have to spend too much time on this, but I wanted to give you an opportunity to respond.
Well, so, I mean, thank God for Social Security. That's something that was put in place during the Great Depression. And look how everyone benefits from that so enormously. Where would we be without it? I'm sure that it's not going to go bankrupt, and it's going to continue to provide security for people in their old age for centuries to come. And as far as Ukraine, I live in Asia, and I fully support Ukraine's efforts not to be conquered by Russia. Ukraine is a sovereign nation. It clearly doesn't want to be conquered by Russia. And as an ally of the Ukraine, if we don't support them and Ukraine falls to Russian tyranny, then Poland will probably be next, and then Germany. And that will be the start of World War III for sure. Or if China sees that we can't support our allies, that will make them more likely to attack Taiwan. And if they do, that will be the start of a major war between China and the United States. And if that should occur, then it's very likely that China would occupy all of Southeast Asia very quickly, where I live. And if they do, I will have to be on the first plane out of here, or otherwise I'll end up in a prisoner of war camp, just like all the Western people did when the Japanese took over Asia during World War II. So for me, I see this as drawing the line. We either can defend our allies and protect democracies, or we can't. And we can and we should. And therefore, it would be foolish of us not to. The price will be very much higher if we fail to defend Ukraine now than if we have to defend West Germany and all of Europe 5 years from now, and all of Asia.
Okay. All right. If you say so. That's not what I was expecting. I didn't expect that Social Security was going to not be insolvent. Maybe I'm in a little bit of a bubble, but I wasn't prepared for that response. Okay, fair enough. I think I mentioned my point. I think you mentioned yours as well. I certainly want to talk about debt, because I think that the conversation regarding interest rates is something that admittedly I, to a large degree, got wrong. I really didn't anticipate rates to rise. This is something I'm going to repeat. My listeners have heard me talk about this over and over again, because I repeated it over and over again that I didn't think it was going to happen. I'd love to hear your thoughts on the conversation regarding debt, inflation, and now where interest rates are, and particularly in the United States, and your vision about that. And if there is a tie-in to, the overall economy and then the investment landscape as well.
Okay, well, I didn't expect interest rates to move up like that either. I don't think anyone did. If we're looking back to the last time we spoke, at least at that point, the inflation rate was still, after COVID initially started. So interest rates are determined more than anything else by the inflation rate. If the inflation rate goes up, then the Fed has to increase the federal funds rate, and then all the other interest rates move up in line with that. the reason inflation has been so low for so long before COVID was because of globalization. Once globalization kicked in the early 1980s, and the United States started running very large trade deficits with other countries, especially with other countries with very low labor cost, like China and Vietnam and Bangladesh, that was extremely disinflationary. So the price of goods fell and the overall inflation rate remained very low. In fact, the Fed had a hard time making inflation go up to its 2% target. During most of this century before COVID, the inflation rate very often was below the Fed's 2% inflation target. So what happened is, first we got hit by COVID, and that two sides of this story. The Americans were locked down and they couldn't go out and spend money on services. The US government sent them very large stimulus checks. They took these checks and started buying things like iPads and iPhones and jogging machines and other goods. Most of these goods were made in Asia, but Asia was locked down also because of COVID. And so there was on the one side, demand increased because of the stimulus checks from the government. And on the other side, the supply dropped because of COVID and the disruption to the supply chain bottlenecks. The factories across Asia were shut down, so the goods weren't available. So that created the first wave of inflation. And then just about the time that wave was about to abate, Russia invaded Ukraine, and that pushed up energy prices. Gasoline, oil went up to $120 a barrel, and food prices. Ukraine and Russia are big exporters of wheat and corn and other crops, as well as minerals and metals. So that was another round of inflation. So you can view both of these as a big setback to globalization. Globalization was the reason that inflation was low, and the disruption of the supply chain bottlenecks around the world, plus Russia's invasion of Ukraine, were two big blows to globalization. And so the CPI inflation spiked up to 9.1% at the peak in the middle of 2022. And the Fed, of course, didn't foresee these things either. They didn't foresee COVID, and they didn't foresee Russia's invasion of the Ukraine. They were caught off guard. But once they realized what was happening, that inflation was spiking, from when they started hiking interest rates in March 2022, over the next year and a half, they increased them very rapidly up to a range between 5.25% and 5.5%. And that was quite a shock to the system and very unexpected. But their goal was to, slow down demand. That's how the Fed controls inflation. If inflation is too high, they increase interest rates. They try to slow down demand. If the interest rates are high, presumably consumers will spend less and businesses will invest less. That will lead to rising unemployment. And rising unemployment, if people don't have jobs, they can't spend, so the demand goes down. And when demand goes down, then inflation goes down. But that didn't happen. We didn't have a slowdown in the economy. The economy has continued to grow very rapidly compared to its trend growth potential rates. And last year, the unemployment rate was at a low of, I think, 3.3%, 3.4%. And even now, it's only increased to 4.2%, which is very low relative to its normal range over the last 60 years. So the Fed didn't really cool down inflation by cooling off demand. What happened was the supply chain bottlenecks got worked out. COVID is gone, we hope, gone for good, hopefully. And once Asia started exporting again, then supply increased even more than the strong demand, and prices came down. So we once again now have falling goods prices. The price of goods is once again deflating. Goods prices have been falling now for more than a year. And so inflation has come back down. The Fed's favorite measure of inflation is the PCE price index. That's the one it targets. This target is for 2% inflation on the PCE price index. Well, last month that came down to 2.2%. So effectively, the inflation is gone now. And that's why the Fed started cutting interest rates last month by 50 basis points. And it looks like inflation is going to continue. Well, if things persist as they are at the moment, inflation should continue to abate and perhaps even go below the Fed's 2% inflation target, as it was during most of this century. So if that occurs, then the Fed will continue cutting the federal funds rate. And as it does, the other interest rates throughout the economy, like mortgage rates and the 10-year government bond yield and corporate bond yields, will all follow the federal funds rate down.
When you look at overall asset values, obviously the Fed, if we take their stated goals, on face value, which I'm fine to do, everyone has that ability, it's kind of like tinkering with the model. And so if they are reducing rates, I guess the implication is they anticipate that there's going to be weakness in the economy, that the economy is weakening, and they're trying to create a softer landing so that there isn't a really sharp, pronounced recession, 10% plus in unemployment, let alone anything higher than that. But as an investor, it's interesting because we want to balance expectations in terms of looking out into the future. So I guess my question to you is, what do you see in terms of your recession indicators? Do you anticipate we're going to have a recession in 2024 or 2025? And from the guidance you're looking at and also the economic data points, do you think that, another 50 basis points, 150 basis points will balance that weakness out? And so we do have this relative soft landing, or do you anticipate that there might be a significant stock market correction / real estate correction?
Okay, so right now the federal funds rate has been reduced to a range between 4.75% and 5%. So let's just call it 4.9%. 4.9%, that's twice as high as the inflation rate. So that's really very restrictive monetary policy. The inflation rate is 2.2%. The federal funds rate is 4.9%. So the Fed doesn't want to cause a recession unnecessarily. They don't want to create a recession. So now that the inflation rate has come back down, they want to cut interest rates so that the economy continues to be strong. And they have told us in their most recent FOMC dot plot, as they call it, the officials who vote on interest rates give their predictions for where the federal funds rate will be for the next couple of years. And they are predicting that it'll be down to, I think, 4.4% by the end of this year and 3.4% by the end of next year.
Which is very significant. It's very significant.
2.9% by the end of 2026. So that's 200 basis points of cuts that the Fed itself is predicting at the moment. Now, of course, these are just their views at the moment. They will change as circumstances change. But so it's very interesting that how the Fed actually controls the federal funds rate. The Fed, the way they control the federal funds rate, once quantitative easing started, the Fed started creating trillions of dollars beginning at the end of 2008. The Fed's total assets representing the amount of money that they have created. At the end of 2007, it was about just under $1 trillion. At the peak a couple of years ago, it was $9 trillion. So they created $8 trillion between the end of 2007 and 2022. Now they're reversing that, and it's down to about $7 trillion now. But still, the way the Fed creates money is it buys government bonds from the banks that already own the government bonds. And when it buys the bond, it pays for those bonds by making a deposit into the reserve account that belongs to those banks. All the banks have a bank account at the Fed, effectively. It's called the reserve account of the commercial banks. And when the Fed makes a deposit into this reserve account of the commercial banks, it's not depositing money that already existed. It creates money that way. That is the way the Fed creates money, by creating bank reserves, by making deposits in reserve accounts of the banks. So our financial system is absolutely flooded with bank reserves now. Even after the Fed has destroyed almost $2 trillion over the last 2 years through quantitative tightening, our financial system is still flooded with bank reserves. And the way the Fed controls interest rates, the way the Fed makes interest rates go up, is the Fed pays interest to the banks on their bank reserves. So at the moment, the Fed is now paying roughly 4.8% to the banks on all of their bank reserves. The Fed is paying interest to the banks on their bank reserves. Why? because if they do this, the banks will not lend to anyone else at less than 4.8%. Why would the banks lend at less than 4.8% if the Fed's going to pay them 4.8%? So that's how the Fed controls interest rates these days, by paying interest on bank reserves. If the Fed suddenly said, okay, we're not going to pay you any interest on bank reserves, then there would be what I estimate roughly $3.5 trillion of money of bank reserves that exist at the moment. Suddenly, those banks wouldn't be earning 4.9% interest. If the Fed just stopped outright paying any interest on all that money, then suddenly this $3.5 trillion would begin looking around desperately around the economy, and there's nowhere else. No one else is going to pay them 4.9% interest, or even 3.9% interest, or even 2.9% interest. This massive supply of liquidity would cause interest rates in the country to absolutely plunge back toward 1%. So it's interesting and important for people to understand that there's so much excess liquidity in the system that the Fed has to pay the banks interest in order to prevent interest rates from collapsing. So if they decide they want interest rates to move down by 200 basis points, they'll just pay 200 basis points less to the banks on their bank reserves, and interest rates will move down. And that money will begin looking for other places to earn interest. It will be invested in mortgages at much lower mortgage rates, and it will be invested in government bonds at much lower bond yields. So that's how the Fed controls interest rates. Now, that's deviated somewhat from your question. Oh, you ask, do I think that there will be a recession?
Yeah, in particular, like the significance of the recession, because, I don't really have a ton of money in the stock market, but it looks due to a correction to me. The real estate market to a large degree has corrected. Usually the stock market goes and corrects faster than the real estate market. This is unique because of interest rates being so significant for the real estate market in this particular correction for a lot of reasons. But do you anticipate that there's going to be a stock market correction, or do you anticipate that those Fed rate reductions that you just outlined will balance this whole thing out? Meaning that if money's cheaper and can be borrowed easily and there's more liquidity, can the show go on? Or do you anticipate there's going to be a 20+% correction?
So almost everyone expected that there would be a recession last year, including me, but there wasn't. And why wasn't there? Well, I believe the main reason there wasn't a recession last year or this year is that there was so much stimulus during COVID that the government sent out, roughly $5 trillion of government stimulus, with the Fed creating a similar amount of money to help finance that stimulus. This is not something that happens very often. That sort of stimulus, last time we saw something greater than that was World War II. So this was stimulus almost like on a warlike footing, far less than World War II, but still a tremendous amount of stimulus, both fiscal and monetary. For instance, when the government sent out stimulus checks, the Americans who received those checks deposited them into their bank accounts. So the total deposits at commercial banks increased by 40% over just 2 years, between March 2020 and March 2022. This huge surge in deposits, representing a big increase in the wealth of the country. Deposits had never jumped like that or anything like that before. So that created a lot of purchasing power, and with interest rates at 0%, as they were for quite a long time, that made financing very cheap and not only enabled consumers to spend more, but also enabled companies to borrow very cheaply. Perhaps companies like OpenAI was able to obtain funding that they might not have been able to obtain otherwise, and used it to boost their research in new technologies, bearing the fruit that we're seeing now in terms of the extraordinary technological breakthroughs that are happening all around us. So I think the stimulus was the reason. It was just so large. The economy last quarter grew by 3%. And the current estimates are also suggesting it's going to grow by 3% in the third quarter. So that's significantly above what's considered the potential growth rate. So the economy is still strong. So it looks to me like this is not going to go away. Those deposits are still there. And with interest rates coming down now, that should help also boost the economy. It will allow consumers to borrow more cheaply and therefore to consume, and it will allow businesses to borrow more cheaply and therefore to invest. So from those angles, that's all good news for the economy and for the prospects for the stock market. But of course, as always, there are reasons for concern as well. The biggest reason for concern, you alluded to, is that the valuations of asset prices are very high relative to their historic norm. There's one ratio that I always watch very carefully. I call it the wealth to income ratio.
Yeah.
It's published by the Fed every quarter. And what it is household sector net worth. In other words, all the wealth of the Americans minus all of their liabilities, their net worth, in other words, their wealth, divided by disposable personal income. Now they have this data going back to at least 1950. And the average since 1950 for this wealth to income ratio has been 550%. Wealth has been 5.5 times above disposable personal income on average. But during the NASDAQ bubble, this went up to a new all-time high of 620%. And then the NASDAQ bubble popped and the ratio went back to 550, this long-term average. Then a few years later, the property bubble occurred. And this wealth to income ratio went up to a new all-time high of 680%. And then that bubble popped and this went back to 550%. Well, now this ratio is completely off the charts. The previous all-time high in the property bubble was 680%. Now it's 780%. And so this suggests that asset prices are very inflated relative to their historic norm when compared to disposable personal income. And it suggests that asset prices are vulnerable to any sort of correction should something bad happen.
And ask one thing real quick, just to kind of make sure that I'm on the same page. So the reason for that ratio being important is the implication that asset values can rise disproportionately to income. And so, for example, whether it be monetary policy, liquidity, maybe price per earnings just skyrocket, like the stock market in particular, or the property market in particular, increases at a rate which is disproportionate to, let's say, W-2 workers, contract workers, people's monthly or annual income. Is that like a fair summary there?
That's right. I mean, ultimately, people have to earn money to be able to afford an expensive house. And if the house becomes 5 times more than it was a few years ago, and the incomes are just up 1 time compared to 5 years ago, just for example, then it's increasingly difficult for the people to finance the much more expensive house. And so that's why there has to be some relatively constant ratio between the level of wealth, which is asset prices, and income. If the asset prices are too expensive, the income is insufficient to make it possible for the public to finance and to acquire those assets.
Makes sense. And so when this happens, it implies there's like an unhealthy relationship. It implies that there's going to be a correction. It's similar to the price per earnings ratio or any other kind of standard metric. All of them are suggesting there's going to be a pullback. From your perspective, what's your outlook? Like, what are you most excited about investing in? Is that something that you're focused on, or is kind of, economics newsletter, is that your 100% focus, or do you actively invest and, make trades based on your outlook?
So one more word about this wealth to income ratio is actually been at these very high levels now for almost 2 years. And everyone thought that before the Fed started increasing the interest rates, people would argue that the inflated asset prices were justified because the interest rates were very close to zero. But even after the Fed increased the federal funds rate by more than 500 basis points, asset prices remained very inflated. So that was very surprising. One would have expected that these asset prices would have gone down when interest rates went up, but they didn't. They remained high. And now interest rates are starting to go down again. That's supportive. Now, one reason for this, as you said, property prices, home prices have gone up, but the stock market has gone up, and it's been led by the very high-tech companies, the Magnificent Seven, the likes of NVIDIA and Microsoft. And the stock market bottomed just about the time that ChatGPT was announced at the end of, it was almost 2 years ago now. And since then, the stock market has shot up, I don't know, 40 something percent. But it's easy. I never bought into the NASDAQ bubble, back around 1999, 1998, 99, 2000. I was a big disbeliever in that. But honestly, this generative AI is blowing my mind, how quickly it is advancing. And the potential there truly does seem to be extraordinary. So I can understand why stocks like NVIDIA and Microsoft and most of the other Mag 7 have done so well and led the stock market higher. Their revenues are growing rapidly and their profits are growing rapidly. And the potential for this is a technological revolution that's going to profoundly impact the economy at the macroeconomic level. That's why I watch it. My business is called Macro Watch. I normally only discuss factors that affect the economy at the macro level and discuss how those factors will end up affecting asset prices, stock prices, property prices, et cetera, commodities and currencies. And so I normally don't talk about individual stocks, but I did a series of videos on each of the Magnificent Seven explaining what they're doing to develop and profit from the development of artificial intelligence over the last year, among many other videos. So that provides justification for the asset prices being high. And the fall in inflation back now to very close to the Fed's 2% target, that's another reason for optimism. But still, again, I would say this very high wealth to income ratio means that asset prices are vulnerable to any sort of shock. Now, one of the biggest shocks that worries me as a potential risk, anything that causes inflation to rise again would be very bad news for asset prices, because the Fed, if we have another spot in inflation, then the Fed would start increasing interest rates again. And that would really undermine everyone's current optimism. Now, so
can I ask you a question about that real quick?
Sure.
I see where you're going with this, and I want to make sure that we get to this point. So, obviously, especially in the wake of COVID, the Fed effectively printed, use whatever term you want, increased its own balance sheet, injected liquidity, people got money, and also supply chain issues happened. And so we got this inflation. From your perspective, a lot of that liquidity is still there, like you mentioned, and the tune of trillions of dollars was injected into the economy. Is this something that is now, always on the mind? It should be on the mind of investors. Like, do you have a concern about inflation because of the printing of money and the creating of, fiat currency, et cetera?
Well, before COVID, my base case understanding was that globalization was so deflationary that inflation would remain low for the rest of our lives, and therefore interest rates could remain low for the rest of our lives. Of course, I didn't foresee COVID or this war in Europe, and I didn't imagine. In my book, The Money Revolution, I advocated a multi-trillion-dollar government-financed investment in new industries and technologies over the next decade. Well, in the second quarter of 2020, U.S. government debt in 3 months increased by $2.9 trillion in 3 months. And the Fed created $2.9 trillion during that same 3 months to finance government debt at low interest rates. So, of course, I wasn't advocating a multi-trillion-dollar investment over 90 days. I was advocating a multi-trillion-dollar investment over a decade. And so what we saw was such a massive amount of fiscal and monetary stimulus combined with the factors that we've already discussed. Demand increased, supply went away because of the supply chain bottlenecks. But now we're back, I believe we're back to that pre-COVID environment where once again we are in a globalization is reasserting its disinflationary powers, and inflation is going down again. Goods prices are falling again year on year. So we have disinflation. But what worries me most is, for example, I always try to avoid any political discussion whatsoever. And so this is not based on political preferences, but just economic analysis. If we do put 100% trade tariffs on everything made in China and 20% trade tariffs on all of the imports from all of our other trading partners, then that is going to be very inflationary. That's going to cause a spike in inflation, and that will force the Fed to increase interest rates again, which would do a great deal of damage to all the asset prices and to the economy. So that's a real concern. That's the sort of shock that would result in asset prices tumbling and the wealth to income ratio going back to a more normal level in a bad way.
Agreed. All right, I'll ask one more question. And just for the listeners, I've got to give him a shout out. So go over to richardduncaneconomics.com. He actually lives in Thailand. So both of us have to stretch and do these weird times. So I always am very grateful for Richard coming on. So if you want to thank him, if you enjoyed the conversation so far, go to richardduncaneconomics.com. And there's actually going to be a discount code, I believe, that is just simply both, BOTH. And Richard, I'll let you tell why that is in just a second, but I just want to give you a shout out before we wrap up real quick. What is, other than inflation, is there any other recession indicator or market indicator that you're looking at that would be a sign of a significant correction to come or significant interest rate rise to come? Actually, you know what? Those are two very different questions, right? Because if there was a significant recession, obviously rates are going to go down, but people are not going to really be happy about it, such as myself. The other side of it is things start to heat up a little bit, not necessarily in terms of asset values, but in terms of inflation, the rates start to rise. So let's focus on the recession side of things. What recession indicator do you have your eye on that you could trigger a conversation where you'd reach out to me and say, Hunter, brace for impact, it's about to happen?
Okay, well, let me twist this around a bit. If asset prices were to fall sharply, a big stock market correction, then consumption would drop. And if consumption drops, there would be a recession. So let me approach it from that angle. One thing that could cause asset prices to drop is something that we've already had a bit of a taste of already. On August 5th, there was a great deal of volatility in the financial markets around the world that day because the yen carry trade started to come unwound. Now, what is the yen carry trade? Effectively, anyone or banks, investment banks, and big-time investors can easily borrow money in Japan at interest rates that are very near 0%. And then with the money they borrow, they can make investments in, for instance, US government bonds or other US assets or any other assets that are earning more than 0% because they're paying 0% on the money that they borrow. And they're earning a much higher return on the things that they invest in. And if they leverage up, they can make enormous amounts of money from this yen carry trade, it's called. And the yen carry trade is even more profitable as long as the yen keeps getting weaker and weaker. And the yen has been getting weaker up until recently, ever since 2011. So this was a very profitable trade, and it was a very large trade. But things went wrong for this yen carry trade because first, during the week before August 5th, the Bank of Japan increased interest rates more than expected. And also during that week, the US employment numbers came in weaker than expected, which suggested that the Fed was going to begin cutting interest rates more aggressively than had been expected. Now, the significance of that, with what it meant was the investors began to expect US interest rates to come down and Japanese interest rates to go up. So that made the interest rate differential between the two currencies less. Therefore, it made the yen carry trade less profitable. And also, when the interest rate differential between the two currencies become less, that's a good reason for the yen to appreciate. And the yen did start appreciating. The low on the yen was something like 162. It very quickly went to 142. And so suddenly, instead of the yen getting weaker, it got stronger. And that made it more expensive for people to repay the yen that they had borrowed. And apparently, a large number of investors panicked. And that day, August 5th, the Japanese stock market fell 12%. NVIDIA's shares were down at one point 15%. Bitcoin was down 15%. The whole market got slammed across the board. And it's not certain how much of this yen carry trade has been unwound so far. Much of it has been, but I imagine that there's still a considerable, very large amount of money that's still invested in this yen carry trade. And if we see the Fed cutting interest rates by another 200 basis points over the next year, then there's a real risk that this yen carry trade will come unwound further and cause more volatility in the stock market and cause stock prices to fall. So that's another thing to worry about.
All right. Well, we'll have to have you back on if that starts to tip the scales. Richard, as always, man, I really enjoyed the conversation. And again, I appreciate you getting up early. Why don't you, one more time, let listeners know how they can learn more about you, your company, follow you on Twitter, etc.
Right. So my business is called Macro Watch. Macro Watch is a video newsletter. Every couple of weeks, I produce a new video. It's essentially me making a PowerPoint presentation discussing something important happening in the global economy and how that's likely to impact the stock market and the property market and currencies and commodities and other asset prices, wealth in general. The videos tend to be 20 minutes long, and they usually have 30 or 35 charts that can be downloaded. This has been going on now for 11 years. It's coming up to its 11th anniversary this month. And so your listeners can find Macro Watch on my website, which is richardduncaneconomics.com. That's richardduncaneconomics.com. If they would like to subscribe to Macro Watch, hit the subscribe button, and when they do, they'll be prompted to put in a discount coupon code. If they use the word BOTH, B-O-T-H, then they'll receive a 50% subscription discount. I believe they'll all find it very affordable. It's not very expensive. And why do I use the coupon code BOTH this time? I'm using it because both political parties are now supporting a U.S. sovereign wealth fund, which is what I advocated in my book, The Money Revolution. So that's why I'm using the coupon code BOTH. Check it out. At least go there and sign up for my free blog, if nothing else.
Yeah, it's good stuff. And like I said, a lot of great content on there, a lot of great stuff on Twitter too as well. Richard, I really appreciate it. We'll link to that in the show notes page. Thanks again.